When you say the markets have been pricing in like low rates for a long time, even during sort of the fastest rate hike in history, they've been pricing this in. Is that right? And
Yep.
where have they been pricing that in?
Forward markets, interest rate swaps, the yield curve, the Eurodollar futures curve, the old Eurodollar futures curve, the far superior Eurodollar futures curve inverted back in December of 2021. So that was
Hmm.
the market saying whatever the Fed's going to do in the short run, interest rates are likely to go lower after a certain period of time. So ever since then, the curves have been completely upended. So you had inversion in the yield curve, the Treasury market yield curve, March of 2022, and it had been inverted and heavily inverted and historically inverted from March of 2022 on and off in the initial stage, but all the way until September of 2024. So the market was saying eventually, once the Fed gets its inflation hysteria out of its system, rates are going to go down. They're going to go down by a lot and stay there. So from the very beginning, 2021, the markets have said over time, this is what we should expect. Not interest rates going into the future, going into double digits, soaring into the skyward. It's not the 1970s. There's no lingering inflation. We should expect things to go the other way. And I mean, to me, that seemed to make sense because the economy tailed off right in 2022. It didn't fall into a recognizable recession, but it was every bit the recession. We've seen the job market weaken along the way in the macroeconomy, not just in the US, but across the entire world. And that makes sense too. You think about what happened in 2021 and 2022, while all this financial irregularity and stupidity was going on, the entire world, or the vast majority of it, was impoverished. You had prices that soared ahead and incomes that didn't come close to making up the difference. So, in other words, everybody fell further behind almost at once. It was like this one big slap in the face. How is that ever going to work out any other way in the future? Especially as these middle market players, these shadow banks were extending credit on, on really stupid assumptions that everything was just going to work out fine. It just got worse and worse and worse over time, but it did so in a way that wasn't recognizable to most people and what they think of and when they hear the term recession. But the macroeconomic base case has always been from 2021 onward that we would end up in this situation for that reason, because you can't impoverish the vast majority of the world and expect it all just to work out fine and dandy.
Hmm. So when you say that rate cuts are basically baked in the cake at this point, like Kevin Walsh is obviously or most likely coming in as Fed chair in, is it in May, I think? What do you
Yeah.
think the difference he will make there will be? Because and maybe it's worth explaining why you think the Fed doesn't matter as part of that answer for anyone that's not heard you before.
Yeah. Thanks for anticipating my answer. I really appreciate it. No, it won't matter. Jay Powell, Warsh, or anybody else who got the job, whether it was Waller or maybe even Jeff Schmid from Kansas City, who is the the biggest hawk on the committee, wouldn't matter. What the markets are saying is that conditions develop to the point where the Fed has no choice. Like 2008. Before 2008, the Fed had no intentions of lowering interest rates. In fact, when they look at inversion in Eurodollar futures in 2007, they said, what the hell's the market pricing? We don't see anything bad taking place. We're not going to cut rates. We just raised them. We just stopped raising rates. Why would we cut rates? So it's what the market is saying is regardless who's at the Fed, conditions are going to be such that they have no choice but to respond in the way that we think they're going to respond, which is if we have a credit crisis that leads to higher unemployment, it doesn't matter what anybody at the Fed says today, they're going to lower rates and they're going to lower rates by a lot. It's not the Fed's choice. It's the conditions around the Fed that the market says the Fed will have to respond to, which is why lower interest rates, contrary to popular perception, lower interest rates are not stimulus. It is officials reacting to what's taking place in reality. So that's why interest rates go down during recessions rather than interest rates go down and stop the recession from happening. They're responding to the recession that's developing or the financial crisis, whatever comes along with it. So that's what the market is saying. The market is saying the Fed is likely, balance of probabilities, to respond to some whatever conditions they are, respond in a way that like they did in previous cycles. They're going to bring rates down, not all at once, as we've seen. I mean, this is a drawn out cycle. It's one of the most drawn out rate cutting cycles that we've seen. But over time, eventually they get there. And they get there because they don't have a choice.
I don't know if I've ever asked you this question because I know you don't like the Fed, but do you think we should get rid of the Fed?
It's not that I don't like the Fed. Well, I mean, there's lots of question about the Fed. The Fed isn't what people think it is, and the Fed isn't what the Fed advertises itself to be. That's what I really have a problem with. The Fed has you believing this is money printing engine, when it doesn't have a money printer. And in fact, if you put a gun to Jay Powell's head, he would admit it to you. In fact, it's a dirty secret they never talk about. One thing you never hear come out of Jay Powell's mouth is money, money supply, money circulation, money anything. They say monetary policy, but that's really interest rate policy. It's not monetary policy. They are not targeting a money supply. They're not doing anything with money supply. So they've given this impression that they're a monetary institution when they're not, which is my biggest beef with the Fed, is they are pretending to be what they are absolutely not. So can we get rid of the Fed? That part of it, yes. Now, that doesn't mean that some parts of the Fed are salvageable. For example, I use the Fed all the time in terms of information. It is one of the few sources of information into these dark spots that we otherwise would not have because of the Eurodollar system and its opaque nature, offshore, hidden in the footnotes of bank balance sheets. And a lot of stuff doesn't even show up on bank balance sheets or shadow bank balance sheets in these days. So the Fed does have some use. It uses its power of subpoena and regulatory authority, macroprudential power to force some kind of transparency, not nearly enough. But the idea that the Fed controls the economy and the monetary system and then can generate predictable positive outcomes by moving the federal funds rate around, that's total horse crap.
So it's just a statistics and PR agency at this point.
Yeah, I mean, you listen to how the Feds, when they talk about interest rate policy, what they say is it works through long and variable lags. That immediately should raise alarm bells, because what they're saying is if we raise rates, we have no idea when the effect of raising rates will take place. At some point, the outcome that we were anticipating by raising rates will take place, and then we'll take credit for it. In other words, it could take 3 years. I mean, think about it this way. The Fed, as you mentioned already, most aggressive, quickest rate hiking campaign in its history. Yet here we are 3-4 years later, still talking about inflation risk. Why is that the case? Long and variable lags. They anticipated the outcome and they're waiting for that outcome to show up so they can take credit for it. It's essentially turning correlation into causation, which is what the Fed has been doing basically its entire history, but more so since the Eurodollar development in the 60s and 70s. So whenever the Fed does something, most people don't pay attention to what it is they do. And if it correlates with the outcome the Fed is, they've taught you to believe in, you think the Fed is responsible for it. But like I said, if that was the case, we would never have recessions, because the Fed lowers interest rates heading into a recession. We get the recession anyway, and which leaves the Fed to say, well, it would have been worse if we hadn't lowered rates. That's the other way they get around this. Long and variable lags or jobs saved, like in 2008. Well, it would have been 1930s if we hadn't acted with QE. So that's my problem with the Fed. It's giving people the wrong impression about what it is and what it actually does. The portfolio that performs in one economic regime can get crushed in the next. So in this free webinar, we're going to reveal what those 4 economic regimes are, how to identify them, as well as the assets, historically speaking, best positioned to perform in every environment. So reserve your seat now and learn how to prepare your portfolio before the economy shifts again.